All right, let's talk about it. We're diving into one of the biggest, most stubborn myths in the entire investing world. It's the one number that pretty much everyone obsesses over, and you know what? It often costs them a ton of money.
I mean, you've seen this a million times, right? In comment sections, on Reddit, you name it. You bring up an ETF and the very first thing people jump on is the fee. It's this automatic, knee-jerk reaction for so many investors.
And, to be fair, this whole obsession didn't just pop out of thin air. It's actually rooted in some pretty painful history that's worth understanding. But here's the thing. In today's market, it's completely, totally outdated. Let's get into why.
So this is what the old world of investing looked like. 30 years ago, if you wanted to buy a mutual fund, you got slammed with a massive upfront load fee. We're talking 5, 6, even 8%. You were in the hole the second you bought in, and that was before you even got to the high annual fees and all the other hidden costs. Back then, obsessing over fees wasn't just being smart, it was literally financial self-defense.
But then, ETFs came along and completely changed the game. The old rulebook got tossed out the window, but that fee-first thinking, it just kind of stuck around. And it's all because most investors miss one absolutely critical, fundamental truth about how ETFs actually work today.
So what is this game-changing detail? What's the one single fact that flips this entire fee argument completely on its head?
This is it. This one sentence changes everything. Any chart you pull up, doesn't matter if it's on Yahoo Finance, in your brokerage app, wherever, the performance line that you see has already had the fee taken out.
When we say net of fees, what we mean is the expense ratio isn't some bill you pay separately. It's a tiny, tiny slice that's deducted from the fund's assets every single day behind the scenes. The key takeaway is right here. The fee is in the line. That chart you're looking at is your actual real-world results after all the costs are paid. Okay, theory is one thing, but let's put this to the test. Let's watch a real-world showdown that shows exactly why this is so important.
Imagine we have two ETFs. They both invest in the same thing, big U.S. stocks. Fund A has a nice low fee of 0.20%. Fund B, on the other hand, has a fee that is 10 times higher, a whopping 2.0%. Now, based on everything you've ever heard, which one is the no-brainer, the obvious winner?
But look at the actual results. Over 15 years, Fund B, the expensive one, gave investors a total return of 340%. The cheap fund? Only 315%. The fund that charged 10 times more actually ended up putting more money in your pocket.
Let's be really clear about what that 25% means. It means you would have made significantly more money by choosing the fund with the higher fee, because the only thing that matters is the final number, and that number is always, always, always net of fees. This analogy is just perfect. Think about it. Would you ever turn down a real estate agent who gets you an extra 40 grand for your house just because her commission is 1% higher? No way. You'd focus on the net outcome, the cash you actually walk away with. Yet for some reason, we do the exact opposite with our investments all the time.
Okay, so if the expense ratio is the wrong thing to focus on, what's the right thing? Let's build a new, much smarter checklist for how to look at any ETF.
So first and foremost, the king of the list, total return, the net result after fees. But it doesn't stop there. You also have to think about the income it kicks off, its volatility, like can you actually sleep at night during the downturns? You got to check its true exposure to make sure you're buying what you think you're buying. And finally, look at its liquidity. For some funds, the bid-ask spread can actually cost you more in a single trade than years of the expense ratio. These are the things that actually move the needle.
Okay, so does this mean fees never matter? Well, not exactly. They matter in a few very specific, very rare situations. Like if you find two funds that are identical twins in every single way, same strategy, same holdings, same everything, then yeah, of course you take the cheaper one. But that's the exception, not the rule.
So let's put this all together into a simple, actionable playbook that you can use literally the next time you're trying to decide between two funds.
Forget digging around for the expense ratio. Just do this simple test instead. Pick a start date, see what the price was then, see what it is now, and just add up all the dividends that were paid out in between. Most charting websites will actually do this total return calculation for you.
And here it is. This is your new golden rule. The fund that gives you the biggest number at the end of that simple calculation is the winner. That's it, full stop, because that final number is the only scoreboard that matters.
This is really all about shifting your focus to where it has the biggest impact. The lion's share of your attention, we're talking 70%, should be on total return. The fund strategy and the income it produces, maybe another 20%. Volatility gets a little slice. And the expense ratio? It belongs way down there in that last 5% as a tiny tiebreaker, not the main event.
The source material for this whole explainer puts it perfectly. Stop fighting the last war. The big battle against those crazy predatory mutual fund fees, it was won years and years ago. Obsessing over tiny differences in ETF expense ratios today is just fighting a ghost.
So I'll just leave you with this question to think about. When it comes to your money, what's really more important? The price you pay for the ticket or how much cash you actually have in your pocket when the ride is all over?